each year, live 2 hours immersion, 6 speakers in total. And just as a welcome icebreaker, if I could engage with you all, FSC collective community from around the world, share your response in the Zoom chat box, which country you are based in, any market cycle views, key insights from the FSC market forecast 2025 so far. We've had day 1 and day 2, so plenty to share there. So let's perhaps kick off with where are you from? We can see here Victoria from USA, our chairman also stateside, but we also have people across the other side of the world, Australia. Mukund, good morning to you. Mary from Tampa, Florida. Jamie from Ireland. Mark from Chicago. Michelle from Florida. Robert from California. And we have another person from Australia, Sydney side, and the list goes on. Roger from London. Hey, a big hi to you. Andy Pincholi and myself are based in London, so we look forward to potentially catching up with you at one of the industry events. Philippe from France. Great. So we have some European representation. Freddie from Germany. Pedro from Lisbon. We have a even more of a broader audience this time around than yesterday, which is always interesting to see. So a big welcome to everyone. And if I can encourage, I mean, those of you that already shared, and maybe those of you that are still keen to, what's your market view? Are you bullish, bearish, risk on, risk off, equity markets, currencies, commodities, fixed income? What cycles are you watching and why? And any warm-up questions you have for our first speaker, which will be Bill Sarubbi in a few moments. So top of mind market views, cycles that you might be watching. We had some great cycle chat yesterday in terms of different timing methods that people use, technical questions as to how to apply cycles, and then a whole bunch of cycle outlook questions that we received yesterday. Thomas is bullish on Bitcoin, which is interesting because we had a contrarian non-consensus Bitcoin top call by Jake and Andy yesterday, so that was interesting. Mary is bearish in general. Ludwig is looking for a new cycle, new to cycles, so looking to learn. Absolutely fine. You can be here just for educational reasons. No need to be market-centric focused. Geordie's a bull. Michelle's bullish on gold, natural gas based on the technicals, and Piers missed the 2 last webinars, so welcome for this grand finale third. And Sergey's on a crash alert for next week. So we have the full spectrum here of different views. Hey, Bruno, SCA from Switzerland, with a macro view there on treasuries. Okay, let's kickstart now that we've warmed up with the audience around the world. Our main focus for yesterday was with our speakers, Jake Bernstein, who spoke about cycle reveal, best trades in 2025, Andrew Pincholi, 2025 markets and musings, and there was a mix of market outlook, cycle applications with variations, and mostly a concurrent view between the two of them on markets with some lead and lag, and some nuances in terms of the macro outlook. Looking ahead, remember to mark your diaries, FSC live in 2025, trailer to follow, first live FSC events in decades, leading experts in cycle insights, and my most important reason to be there, the magic of being at an in-person event, meeting with human beings, experts in the field, and sharing that passion for market timing. I will pause on that point and let the video do the rest. One moment. Okay, you saw it there. Register now. We've got lots of live registrants. Join us for live in 2025 as an in-person conference on June 12th to 14th in New York. The link's in the chat, so click now and mark your diary and confirm. With no further ado, the agenda for today will be my FSC team colleague, Bill Sarubbi, on US markets, and then myself following up on Trump 2.0 melt-up or cycle peak. Following with Bill here and now, Bill Sarubbi is a regular Forbes contributor. Sarubbi operates his own money management and consulting service. He was an analyst, institutional broker, and technical strategist on Wall Street, and a technology fund manager, North American strategist, and member of the currency hedging committee with the Abu Dhabi Investment Authority. Sarubbi is on the FSC's board of director. And Bill, I'm always looking to share your insights, especially as we bridge into this new year. Over to you, Bill.
Okay, so let's see, share screen. Oh, there it is. Okay. Share. I have to move this out of my way. Well, thank you for that nice introduction. And initially I thought 2025 would be an easy layup. And well, big question, when will the deteriorating fundamental conditions bring the stock market down? It is more likely to occur later in the decade than in 2025, usually in years ending in 7 or 0. I'm a big believer in the decennial pattern of Edgar Lawrence Smith. And I'll put this all together as we go through here. There's too much money lifting all asset classes. In order to monitor this, I look at the auction markets. I look at the steak dinner that we had in the spring in New York in the Lower East Village for $315. Parking the car was $50. I remember when it was $5. Then there was the 54-year cycle. That's 3 18-year cycles. It will be explained some other time. Every third one is the most important. So 3 times 18 is 54. For example, Russia took the Crimea 161 years after the Crimean War. So that's 3 times 52 minus 1 year is 161. So this works in history and society. And so I look at it to get some idea of what fundamental conditions might be. So if we go to 2025 and we deduct 54, we come to 1971, which is when the Fillmore East closed, the psychedelic era ended, the disco era started, and there was inflation, social unrest, rising interest rates, a declining stock market, and rising commodity markets. If you missed the 70s, you were lucky, because the stock market at best, well, it went from 1,000, I think, in the late 60s to about 500 in December 74. I'm driving along and I saw a sign that said survive in 75. The market bottomed then, by the way. So not only did the market go down, but there was price inflation, and you had a real destruction of wealth. The money you got back out of the stock market did not have the purchasing power. So you can already see pieces of that right now with the rising rates and commodity prices lifting, etc. So auctions tell us there is too much money. This is the banana that sold, I think, for $1 million, and the guy took it off the wall and then ate it. That's excessive, but I have further excesses here. $1 million shoes up for sale. The Wizard of Oz, Judy Garland's ruby slippers are up for auction. And my favorite, baseball star Juan Soto did not renew his contract with the New York Yankees. He signed with a 15-year contract with the New York Mets for $765 million. That is $51 million per year, $315,000 per game, about $90,000 per at bat, and about $131,000 per hit. If you have been a fan for a long time, you might recall when Mickey Mantle and Willie Mays became the first 2 players to break the $100,000 annual salary barrier. If this is not excess, I don't know what is. This guy, Juan Soto, gets $90,000 per at bat, and Mickey and Willie got 100,000 for an entire year, which is about 5 to 600 at bats. So bubbles usually do not occur in years ending in five, where they do not burst, I should say. And the fundamental cause, and I think most people miss this, listen to people in the media all the time. On August 15th, 1971, Nixon closed the gold window. On March 31, 1980, Carter signed the Monetary Control Act, which, if you understand it, it says that the Fed can monetize anything. It can buy all of our American Express card debt and put it on their balance sheets as an asset and then issue credit against that. And if you think that makes sense, then you should probably join the Fed, I guess. This enabled the Fed to monetize any paper. So the debt of some foreign country was only worth 10 cents on the dollar. They would buy it from them on a dollar basis, sit on it as though it were worth 10 times what it's worth. They didn't mark it down to market value. They kept it on their books. So this is the Fed assets have gone straight up. They've inflated the currency tremendously. So there's few limits on what can be monetized. If there's no limit on what can be monetized, that $350 steak when I get back to New York might be $600. There is no limit to price increases. So why shouldn't the stock market go up? So my original forecast was originally for a Q4 rally into a January top, which is turning out to be a bottom. The weak December altered this view. It is very rare for December to be down. It's up about 72% of the time. A rally is now expected from mid-month. Right now, it began yesterday or Tuesday into February, followed by, I think, maybe a little decline into March. 2025 is expected to close up about 10% in a volatile year. And I think the reasons for the volatility are we don't know what the new president is going to do. He's obviously going to have policies that are very different from the prior president. I think that will cause a great deal of volatility. And you've got a lot of people out there who are accustomed to the market going up 20% 2 years in a row. And I think they're going to have a much tougher time this year, which is why I said I think there'll be a greater need for market timing in 2025 than there were in the previous 2 years. So here's the S&P 500. This blue is a rectangle, as you know. You might not know that the Financial Analyst Journal actually had an article by PhDs that wrote a fuzzy logic program that detects different technical formations. The rectangle was the single most numerous formation. Rectangular lows were the most profitable, much more than rectangular highs. So this blue rectangle, according to the PhDs, is very reliable. And using cycles, I predicted it would break out. And if it breaks out, the blue line, you project that height of the rectangle up and you get 6,100. The S&P touched 6,100 and immediately came down. But there's a big green rectangle, or you could draw it in another way and make it a symmetrical triangle. I prefer to call it a rectangle. That counts to 6,300, 6,400. So right now, this is not updated for today, obviously, but right now we are about here. So this is the 10 days advances, less declines. You can see how oversold it has been. This is one of my primary short-term indicators. Now, here is a short-term view with a monthly cycle, which is not updated, obviously, because otherwise the S&P would be up here. Now, you can see why I was expecting a mid-month low. Here is a blow-up of it, which extends out further through 2025. And you can see, according to this, the rally should carry up into May. And by the way, it is the turning points that are important. The magnitude doesn't mean this market's going to go to the moon. And this decline doesn't mean that it's going to crash. It means there's a high likelihood of the market turning down here in July and of us having a July-August correction. And then a rocky Q4. And this is calling for a weak close to the year, which I would dispute, but we'll look further. Now, here's the NASDAQ monthly, and notice it bottomed at the same time the S&P was bottoming, so this is confirmation. Now, this is all post-election years in the Dow Jones Industrial Average from 1885. There have been 34. January up, February down. If you go to Arthur Merrill's book, Behavior of Prices on Wall Street, which was first issued in the late 60s, then I think updated in 84, February's in post-election years have been the weakest of all of the 48 months in this 48-month cycle. So that's why I think we would at least see a pullback in this current rally beginning probably no later than the 10th or 15th of March, of February, I mean. Then we get a rally up with a strong, we usually do get a strong April. It's the second strongest month next to January. Then another sell-off. June is usually weak. But I think the interesting thing is it shows a flat August and a weak September and October. And here you see a fourth quarter rally. But it's also, we must take into account the decennial pattern. This is all years ending in 5 in the Dow Jones from 1885. Again, this is expected return. So in other words, if there's a 50% chance of a 3.5% rally, then we get 1.75 on this axis. And as you can see, there's not a negative year anywhere on this graph because years in 5 are the most bullish. Some of them, one of them was down about 50 basis points, I think. Some have been very weak, some have been very strong. There are only 13 of them. So years after the election have tended to be the weakest in that 4-year cycle. Years ending in 5 have tended to be the strongest in the decennial cycle, which sets up a bit of a conflict. Here's the histogram of monthly expected return, combining both years ending in 5 that have also been post-election years. So here you get an up January, an up somewhat February, and a down March, then a rally up into May, again a weak June, so I've got 2 counts on a weak June, and then a strong remainder of the year. There have only been 6 of these. So we're looking at the cycles from all different angles and coming up with what Stan Weinstein used to call the weight of the evidence. So let me see. I think it's the slide should be up here. It's further down, but there have been 6 times when these cycles have conflicted. In other words, we had a post-election year and a year ending in 5. In 5 of the 6, the market was up in the year ending in 5. So the year ending in 5 effect completely overwhelmed or absorbed or mitigated the effect of the post-election year. So we can forget about that conflict, years ending in 5 when. But I have some modifiers, 3 of them. After 2 consecutive years of 20% gains, the S&P usually returns 10%. The big exception is 95, 96, 97, 98. We're all up 20%. And then there's the 54-year cycle, which I already mentioned, which that was during a weak market. And here is how the third one, how the 3 indices reacted in the next year after an up or down December. Dow Jones from 1885, if December is up, then the next year is up 61% of the time. But if it's down, it's 55%. If the S&P is S&P from 1928, if December is up, the S&P is up 66% of the time, but if it is down in December, it's 52%. And the NASDAQ comp, we only have data from 1980. December is up. If December is up, then the subsequent year is up 68% of the time. But if December is down, then that number falls from 68 down to 59. So these are 3 modifiers which suggest not that we won't have an up market in the year ending in 5, but that we would have reduced returns. Now, we can't leave out the 1-4 10-year cycle. I did that in histogram form, but let's look at the waves. And I think, as you know by now, that red is the 1-year cycle, which is the average cycle of the year. And the Financial Analyst Journal actually tested this, and they call it seasonal attention disorder, or SAD, which is the name of the paper. And statistically, they simply acknowledge that it exists. They don't know why the seasonality exists, and they don't know why we usually get this sell-off in September and why most lows occur in October. So that is the 1-year cycle. And the blue is the 4-year cycle, which is known as the presidential election cycle. But as the late Ian Notley used to point out, the presidential cycle, that 4-year cycle, existed prior to the establishment of the Federal Reserve in 1913. It exists in countries where there's a 4-year election cycle, a 6-year election cycle, or no elections whatsoever. In other words, there's a 4-year cycle. And of course, the green one is the decennial pattern. And of course, it's a year ending in 5, so no surprise that that green line goes up most of the year. So if we add them all together, we get this blue line down here. This would suggest we did not have a strong first half of January, but it does suggest a bit of a trading range. And here again, you notice how we get this little high in February, it declined into March over here, and then the strength returns in April, and then we sell off again. You see why I think we might need market timing more than ever. Then a June low, September high. And by the way, the old DOS program, the first one I ever worked on, we had a facility where you could issue a command and leave out 1929, because if you leave out 1929, this doesn't look like an Austrian ski slope here. It looks much more tame. I mean, a 90% decline will do a real number on the numbers, if you know what I mean. So this is the 1-4 10-year cycle in Q1 only. So again, you see this low, that looks like the low from the prior dynamic cycles. Those blue lines you saw earlier, those are dynamic cycles, and those are black lines, which means they were drawn from the most recent data by my program. These are static cycles, and that the 1-4 10-year cycles hardly change. So we have confirmation. So we have confirmation now of a rally probably up until February, and then some sort of a correction and a low somewhere in March. So this slide, which should have been up further, 2025 sets up a conflict. Years after the election have been the weakest in the 4-year election cycle, but years ending in 5 have been the strongest in the decennial cycle. There have been 6 such conflicting years since 1885. 5 of 6 have closed substantially higher. 1 was down slightly. The average was a 33% gain. I don't think, due to the modifiers, I don't think we're going to get that this year. And here is the little study that I did just for your perusal. The election year is 1904, year ending in 5, 1905, 1924, 25, 44, 45, 64, and on down. And you can see the percentage changes over here in the right column. So again, the bullish effect of the 5-year dominates, so I remain bullish from this perspective. Now, one change I do expect, and after the roaring first half of last year, I said technology cannot keep going up at this rate. NVIDIA, I said, will be up in the second half, but not as much as it was up in the first half. Therefore, if the market is going to continue to go higher, it's either going to be other technology stocks that are going to rally, or it's going to be other sectors are going to come to life. And that proved to be correct. But as we get into this year, I think healthcare, that sector is very weak. I don't know if it is going to recover very much this year. Base materials, we're in an inflationary environment, maybe, but these are the strongest stocks from my software on 2 bases: relative strength, which is very important, and seasonality. So number 2 is Citigroup, which I already bought, and they reported earnings yesterday and jumped about 6 or 7%. This is JP Morgan. That is Co-America. Is it Co-America Financial? COF, I forget exactly what that is, but BAC we know is Bank America. Now here's Triple M. Now here we come to our first technology stock, but it's old iron. It's IBM. Then we have Morgan Stanley, Metropolitan Life, a U.S. Bank Corp. Now we come to Apple, Texas Instruments. Actually, Walgreen is showing enough strength to make it looks like this. If you like risk, you can bet on a Walgreen turnaround, according to this. Then there's AT&T, Medtronic, American Express, GE, First Energy stock, Occidental Petroleum, Caterpillar. Wait a minute, WFC is, I think that is Wells Fargo. And then Now look where Nvidia is. Nvidia was number one. So financial stocks are the emerging replacements for the technology stocks that are not keeping up with the market. And my favorite out of this group is Citigroup, which I said is we already bought, or I already bought. There's no we. And here you can see other financial stocks that are very strong. Now this is last July. The stocks that I recommended long were up about 6%. Short, they were down. The group was down 1.26%, which are not spectacular numbers, but they went in the right directions. And this product is for a long short equity fund. My favorite, in which I made the most money last year, is Grindr, which is the dating website for the LGBTQ plus community. Don't want to leave anybody out. Then, of course, there was Google, Goldman Sachs, Oracle, HPQ is Hewlett. What do they call it now? Hewlett Compaq, and Apple, Costco, Qualcomm, the down stocks, Autodesk, Walgreen Boots, Ford, and Uber. So stocks right now. What came up number one on my list was Citigroup, which is why I bought it. Number two, Carnival Cruise Lines. Number three, Triple M, which seems to go up no matter what happens. I guess people use those stick-it notes no matter what the economic climate is. LUMN is Illumina, I think. And LUV, of course, is the airline, Southwest Airline. Nordson, which I'm short, Adobe. That is, I think, Equifax. And ALK is Alaska Airlines. They report next week. And when there are a lot of very short-term cycles on a daily basis, turning down or maybe even weekly, during the earnings reporting time, that usually sets up an earnings disappointment. Now, the earnings don't have to disappoint. The cycles tell us people are going to sell the stock no matter what the earnings are. We've all seen cases where the earnings were up or met expectations. And of course, the commentator in the media will say, well, I guess investors were looking for something better. So I think that is the case with Alaska Airlines. Other than that, I'm bullish on the airlines. Now, this is the value of cycles if you're a fund manager. I pointed this out, I don't know, it was around September that I saw this this cycle peak right here. And so I had said there's another cycle peak you can't see back here in June. That's one of the reasons I thought NVIDIA would be weak in the second half of the year. And you could see very little progress has been made from November through to the current time. And actually, it is a bit down. And you could see the buy signal failed. Well, if a buy signal fails and the sell signals succeed, here you had, well, that one didn't quite succeed either. But if the buy signals are failing and you're coming to a cycle peak, that is a bearish sign. Now, added to that was one of my favorite tools, namely contrary opinion. And here was the contrary opinion. This is November 18th, 2024. Being on the cover of Barron's is not bullish. As I pointed out in one of the last presentations I did with the foundation, Kamala Harris was on the cover of Time and the cover of Barron's. Now, that's not two strikes against you, that's three. Because, according to the research of Paul McRae Montgomery, if a financial story, for example, appears on the cover of People magazine or Ladies' Home Journal, those are not financial publications. That means the trend is so strongly developed that it's pressing right through the financial media into the regular media. Well, the winner of the election, it's a political event. And what is it doing on the cover of Barron's? It's a financial publication. So that was very bearish for the vice president. And here we have NVIDIA, November 18th, 2024, and that was the date of the publication. So you had a combination of the cycle, which is really a cycle of buying and selling. And as I always say to people, and this is a point you could never get across, we don't own the companies. I used to say this at Audio, we own the share price. And the share price means everyone else has got to agree with us. If they disagree for whatever reason, we're buying against their selling, the relative strength turns down and we're swimming upstream, we're walking up the down escalator, and we're eating soup with a fork. So relative strength is exceptionally important. And these cycle lines and stocks to me are just, it's like people like, let's say, from here to here, people like vanilla, and from here to here, people like chocolate. It's just the mood toward the prices of the stocks. And they shift and change, and we try to capture it with these cycles. So now let's shift over to the bond market. And as I've said several times, I think bonds are headed into a big bear market because I was around in the 70s. And I got out of school in 1972 with my BS and MBA. And it was like being in, there was an old comedy record album called Everything You Know Is Wrong. And I got out with these 2 degrees and nothing I had been taught worked. And I ran into guys who were trading the market and making a ton of money. I ran into Joe Granville, Bob Prechter, Frankie Joe, one of the greatest traders in the history of Wall Street, 60s through 83. And they did none of the stuff that I was taught. And I watched interest rates go up and up and up and up and up and up. And they finally peaked, what was it, 1980? And started to go down. And none of the commentary was correct. So this is 42 years worth of U.S. 10-year note prices. And where are we right now? We're headed into the most bearish month. January's up, February's flat, March is down, but bonds are down already. And so that's the static cycle. And the static cycle doesn't change very much. Let's look at the dynamic cycle. Is that confirmation? It's got notes going down all year. So so between now and late March, I would not even expect a rally, or maybe even into April. Now, let's look at the oil seasonality. Here we're in the reverse situation. There's January, February, March, April, and May. So this is there's very little, this is the Bermuda Triangle for oil. There's very few setups. I mean, Jake talks about setups and the preconditions. I haven't found too much that will save oil in October and November. They're down a very most of the time in that time period. And if you can see the bottom of the screen here this is rather, can I get this out of the way? Oops, now I'm loading apps. Yeah, we can move this up here. From February 12th to May 21, price has risen 63% of the time. From March 20th to May 21, the percentage rises to 75%, 75.6%. Now, the exchanges do not send out engraved invitations to buy, but if they did, this is what it would look like. So one thing you don't want to do here is be short oil except for short time periods. And that's the reason we're starting to get some lift in the energy stocks. I think Schlumberger will report good earnings. I think it's right now, or it's tomorrow morning. So it's time to start looking at energy stocks. Did they rally in the 70s? Oh, they rallied. And in fact, I was at the Value Line Investment Survey in the 70s, and the poor guy who covered oil, he kept saying, you call me every time for stock of the week. Now, let me explain. They wanted a big write-up once a week, stock of the week. The analysts called it the shock of the week. Nobody wanted to do the extra work. And this guy named Sam, he was the energy analyst, and they kept calling on him. He said, you called on me last week and 3 out of the last 4. And I said, but Sam, energy stocks are the only thing going up, energy and gas. And actually, to give you a little side story, the Value Line stocks are ranked 1 for the strongest, 5 for the weakest. And they go to the top 100 and they pick the stock of the week. So at that time, analysts had the ability, if you put a sell on it, your stock ranked number 1 dropped to a 2. If it was ranked 2 and you put a buy on it, it rose to a 1. So not wanting the stock of the week, everybody would hang sell signals on the 1 ranked stocks to reduce them to 2 so they didn't get the shock of the week. So the internal workings of Value Line. So that is how the energy market looks. And I haven't updated this from last time, but because the computer that does this was just repaired, the guy left 10 minutes before I started speaking. So price is about here, but look at this. This isn't even overbought yet. Quarterly oil from 1880. and that was called back here. Ian Notley had this data, the wellhead price of oil, and it's been kept on, I think, an annual basis since 1880 from the oil fields in Pennsylvania. Now, here's the monthly oil from 1880. It looks a bit different with a lot of Fibonacci retracements. Again, I couldn't update this either, but right now we're up about here. So we're sort of at the, we're at a 50% retracement level. I don't think that 23.6 means anything anymore. As I said, I was unable to change the chart due to the lack of availability of the PC that does that. But you can see we're really in mid-range. We're not, you can't say we're very overbought. You can't say we'll probably never be down here again. And now let's shift over to gold. Now, gold, as you can see, let's look at these. Oh, I don't think I have the static cycle in here, but maybe we do. That is the cycle. And this down here, I decided to put this little box in here. The strongest cycle that my software picks up is 81 days. Second is 120, then 63, then 86.4. And Richard Mogi used to tell me, we'll take these two, 81 and 86, and combine them. And then we have 109. Those cycles are swinging up right now. That is one reason I'm long gold. Let's look at the technicals for confirmation. Gold to 3,100 bucks. Why is that? Again, we have what? The most reliable formation, the rectangle. And we know it's reliable because the Financial Analyst Journal told us that. And prices should rise after they break out of the rectangle by the height of the rectangle, which would put us at 3,100. Now, this has been confirmed very recently. How is that? Here's a breakout from a triangle. See the big triangle? You break out here. You take the height of this triangle, add it on to the point of breakout, and again, you get $3,100. The only question is, when will it get there? And where are we right now? We're in a very strong month. That's the expected return of gold over 42 years in the month of January. You see February is flat. March is the single most bearish, is the probably you could say the only bearish month for gold. And then you have a rise from March up until August. And actually, August and September have typically been, in most recent years, September has been much stronger than this. It was weak years ago. But as most people know, if you get an up June, you're probably in a bull market, and it just continues on up into August. If you are in a bearish market, then June is usually a low, and then you get this rally into August. So we might get some sell-off here in February, March, but basically I think this cycle dominates, and these two charts confirm the breakout to the upside. And why not? It's a reaction to all the inflating that's going on. Juan Soto's baseball salary, $1 million for the ruby red slippers, and what was that, $1 million banana? And I have a whole, I watch these auctions, and I keep track of all of this stuff as a measure of the froth, which is something that I learned in the 70s when the price of everything, it was like a snake snaking through all asset classes, sending them all up much higher. And this is from the July 2024 presentation. The situation is like that of the 1970s, in which rates went well over double digits, equity markets fell, and the economy suffered. Investors sold stocks for less than they paid, and the purchasing power of the remaining funds declined. This was a period of very real wealth destruction. Real estate went into a recession as forecasted by the 18-year real estate cycle, which is again at its high. This trend is likely to continue. So let's just go. This is my latest scan of the relative strength of the sectors. I think this is probably going to stay this way most of the year. Remember, I said that the financial sector, the stocks were coming up. It's not a stock market, it's a market of stocks. So if the financial sector is strong, is it a surprise to see financial stocks coming up at the top of the screens? No. Consumer discretionary, number one. Telecom sector, of which I know little, and then communication services, these two are probably duplicative and one should probably be eliminated. Then there's the S&P 500 benchmark. Then we have the industrials. I would expect that to strengthen a bit, but I expect utilities to decline because I expect rates to go up. Energy sector, was bottom ranked a couple of weeks ago. It was down here where materials are. Now look where it is. And technology, as I said, valuations are restricting technology. Trees don't grow to the moon. And yes, NVIDIA has great problems. And I mean, NVIDIA has great products, I meant to say. And when I published that contrary opinion piece from Barron's and the Cycle, some fund manager disagreed with me on LinkedIn. And then afterwards he said, well, as I was saying, it's a measure of psychology. It's not saying that Tesla's earnings and prospects are not great. It's saying investors have enough Tesla, and you've got to give them much more than what Tesla produced in order to get them to bid the price up any further. So then we have healthcare, which I don't think is going to recover very much. Consumer staples, which include the food group that I used to cover. Periods of rising commodity prices are very tough on food stocks, which are consumer staples, because they can't pass the price increases along fast enough to maintain their profit margins. Now, I followed the food sector for Value Line in the 70s, and it was like being the loneliest analyst on Wall Street. Nobody was interested in food stocks. And so the phone never rang. And in 1980, now Smith Barney used to have these great chart books that went back to the end of World War II. And it showed the food group in a big 25-year rectangle. It broke out of that rectangle in 81. I was with Alan Shaw and the guys at Smith Barney, and they said, hey, what's going on in the food industry? Are people eating more? And I said, no, why do you ask? Because the food group broke out of that reliable 25-year triangle and went on a relative strength tear for 13 years. Usually, you take the amount of time it's been in the rectangle, multiply it by 0.618, which is W.D. Gann's area code, and you get the length of the next move. So real estate, I don't think real estate will recover very much. And in a inflationary environment, materials should at least rise up off the bottom. So that is my presentation. Are there any questions?
Ron, you'll need to unmute, please.
Absolutely, Bill. We have questions, and following a great presentation, and I was just saying just now, wonderful blast from the past insights from yourself, but then also industry peers. I heard you mention Alan Shaw. If we could just spotlight that,
Sure.
just for those who aren't aware, those days when it was Smith Barney and Merrill that were basically watching the flows and managing the TA teams. It was great to capture that if possible.
Yeah, well, I worked at Payne Weber, and if I walked one block north on 6th Avenue, I was at Smith Barney. And they had what's called a war room. There were three in New York. There was one at Smith Barney. There was one under Bob Farrell's direction at Merrill Lynch, where Bob Prechter worked, which is where I met Bob. And then there was one at, the name was just in my mind and it popped out, Kidder Peabody, under the direction of Ralph Acampora. And it was in a bank vault. It was an old bank building, and you walked through the vault into, like you did like a Goldfinger. You walked in and there were all the charts. But Smith Barney's, they had the Chinese gang came in around 5 o'clock, and they updated all the point and figure charts. They had these huge books, and they opened them up, and all these guys are putting in the X's and the O's.
And this is hand drawn.
Yeah, it's Smith Barney. Yeah.
Hand drawn, no computers.
Oh, yeah, that's right. And they had on the wall a hand drawn, it was a daily chart of the Dow that started like on a wall and then went 25 or 30 feet that had been kept up. And my friend Bob Colby, whom I work with at Value Line, he went to Indicator Digest, and then he was hired by Alan Shaw. That's how I got to know Alan. And so I used to go up there, and of course, it was like going from the minor leagues to the major leagues, from Payne Weber, which their technical analysis department consisted of Jim McCarthy and myself and all the charts we could draw by hand.
Wow.
And I used to have a home computer. I used to run stuff off on an old Taitung 286 computer with a line printer, and I used to bring it into work in the morning. And that's how primitive it was. And of course, I'm trying to think of the names now. I forget. I can see the faces, but of course there were three great war rooms, and of course Alan Shaw was, first of all, very well spoken, very confident, and like my old pal Ian Otley, very relaxed. No matter how volatile the market got, he would get you to calm down.
He once shared a humorous note at a US conference, which I
Yes.
managed to meet him in. And he said he was one of the very few technicians that had his brain examined, quite literally, but he was playing on the metaphor. And in recent times, he passed away, but of course, his lifelong heritage continues also in many of the proteges that continued. I believe Luis Yamada is one, and Ralph Ackenper, of course, worked closely with him. And my one of my early mentors, David Fuller, did too before he relocated to the UK.
Uh-huh.
So it's a memory lane, and certainly how it used to be done back in the day. You were talking about chart rooms and war rooms. Fidelity had a chart
Oh yeah.
room
I've been in that
from,
one,
from
sure.
way back when, right?
Yep.
Since the 70s at least.
Yeah, that was that Bill Copeland and I can't remember who Doug Erlanger, Phil Erlanger.
And so some of the questions we're getting from the audience, Bill, I mean, the first one is perhaps a recap on, well, your cycle framework and specifically reference to the presidential election pattern 1 week away from inauguration, Jan 20. So it's top of mind. The question is, could we recap what your work on presidential election patterns suggests this time around? You did already share that, but if we could recap, but then also, are there nuances with certain leaders and policy impacts such as Trump 2.0 in your view?
Well, this year's a bit of a mystery. First of all, I thought the market was going to run straight up into January 15th, correct a little bit in Q1, and we would get another 20% year. And of course, December changed that. And if you start looking at it, like I think we all like to make social comparisons. And 1970, 71, the fade out of the psychedelic era and the start of the disco era makes me think of Jimmy Carter and the Democrats being in charge. And then the subsequent period was Ronald Reagan, that was much more conservative. But now we seem to have a very conservative president, a strong president, going into sort of like walking into the swamp, like mud up to his knees. The debt levels are much higher. I think the country is solidly behind him, but I just think the problems are a little more insurmountable. It's not going to be as, the first thing they did, of course, 80, 82, they rang the inflation out of the system. But as my friend in Parliament in England once said, I've never seen any politician elected on the policy of deflation, which is what is needed. And so I think you're going to get an unusual mishmash. These periods are never the same. In the 70s, I followed the forest products companies, and the fund manager calls me up and says, well, what do you think about Willamette or Boise Cascade? And I said, well, I think the earnings. No, no, no. He said, I don't want to know the earnings. I want to know what the acreage that they own is worth. Like, how much is it worth per acre? And Diamond International traded at 40. The land that they owned was $80 a share. They took themselves private at 100. In other words, the asset value was so great, nobody cared about the earnings. That did not happen with forest products this time around. Hasn't happened yet. Diamond stocks, same thing. Copper, this is all changed. So I don't think, the 70s was not a great time for technology. That was mostly commodities. So I think you'll see more commodities. I sort of agree with Andy and Jake from yesterday. So more commodity-based stocks have probably go up. And so if they go up, that's very bearish for foods. I was following foods in the 70s. They did very poorly. So it's an unusual mishmash of sort of Ronald Reagan and Carter Democratic years. And I think that I don't think there'll be very much warfare. One reason is Donald Trump is right when he talks about lethality. My old pal Jim Dunnigan, now some of you will remember this, Strategy and Tactics Magazine, Simulations Publications Incorporated. We used to play war games with little pieces and roll dice in the 60s into the 70s. Well, Jim was known as the father of modern gaming, and I worked there when I was a student. And so I just got his recent note. I didn't know this. It took 18 shots to kill a tank in World War II. Today, it takes one. So this raises, look what just happened to Russia. And look
Yeah.
what happened to the North Koreans who got thrown into the front. Can anybody afford to fight a war? And I used to get into disputes because in Abu Dhabi, we have a lot of military men, a lot of CIA and um, guys from who knows where, but arms dealers. I got into I used to start discussions. I said, is warfare more likely or less likely in the future if you can send up drones? There's no loss of human life. I mean, look at the Ukrainian drones are doing to the Russian soldiers. And so I was making the argument, well, if you could build, Star Wars, was it the Clone Wars? If you can build machines that fight each other, it seems that he who has the greatest industrial capacity and the most money is going to win, which sort of makes the whole thing sort of unnecessary. It's just a lot of, you get a lot of burnout junk, which is these games I see kids playing in the war game stores. So I think war is less likely because I think Trump is right. He said the lethality is so great that I don't know if anybody wants to fight a war, will fight a war. And I pointed out to Jim Dunnigan in New York. I said, "Do you remember World War One started out with spotter planes? Then they carried 45s and they started to shoot at each other. Then they carried bombs and they started to throw bombs down on people. Well, how did we start with drones? Drones were used for spotting. Then they were equipped. Now we have the I forget the names now, the Reaper and I forget the name of the other one. But these things can do stuff that fighters can't do. They can move at such speeds that it would literally break the pilot's neck. They can come down and swoop very low over the ground. Well, a human pilot could do that, but apparently a drone can't. But the drone can make changes that would just be too destructive to the human body. It can move that quickly. So I'm saying if you fill the air with these things and they've got no pilots, then on one hand, you might say the guys who have the less machines are reluctant to start a war, still run out of people. The people who are manufacturing the war machines want to start a war. So we used to go back and forth. Does it make it more likely or less likely? And so I think it makes it less likely just because it's so utterly destructive. So I don't think.
That sounds like a paradoxical positive
Yes.
happy end to the story, or peaceful end to the story, I should say, particularly with all the polarization that's been in the air and the headline news that has passed of the year of 2024. On that point, Bill, we recently interviewed some cycle practitioners on the FSC TV who were focusing on war cycles, and it's clearly been topical for obvious reason. But just out of interest, there was a question on the determinism of some of these cycle projections. The fact that a cycle projects disruption and potential inevitable event risk. What's your view on how that can play out and where choice potentially exists?
Well, I think individual choice always exists, but then you have crowd psychology. If everybody wants to start a war, they start a war without thinking. And in World War One, at the end of the war, the Germans were yelling at the people, the reinforcements coming up, to not come up because they wanted the war to end. I mean, the spirit just broke. So, we go back and forth like they have people, that drone operators out in the southwestern United States are completely protected from any violence. So how do you stop them? You shoot the drone down and another one replaces it.
And recapping back to your cycles, Bill, you also had a view on the decennial pattern, and it seemed well, you mentioned that there were two different signals on the presidential election for one, and then on the other, on the decennial. What were the divergences, and how do you square that?
Well, I just keep a close eye on the technical indicators. And somebody asked a question here, what I saw it at the bottom of the screen. What technical indicators do I use? Well, I look at pattern perception, but I also follow the 10-day advanced decline line pretty closely. And I used to follow, there are about half a dozen indicators that have become defunct because the numbers aren't printed anymore, but the best was from the old CBOE, was the number of advancing, declining, and unchanged puts and calls, 6 numbers every week. And they stopped 2 years ago, October, publishing them. And if you ever got to minus 200,000 on, let me get this right now, minus 200,000 advancing calls, that was a buy signal. If you got that 2 or 3 weeks in a row, it was a super buy signal. And in other words, it was like a very, very, very sensitive, it was the people who were doing the early buying and taking a lot of leverage. I looked at it that way. It was setting up before anybody else did. And they stopped publishing them along with a bunch of other numbers. So those numbers were very useful. But I also look at the breadth, but of course they went to decimalization and that has thrown that off. So the old breadth thrust numbers from the past don't work as well now. So people have shifted to volume thrust and price thrust. In other words, if you get X% thrust over 5 days, that's big institutions rushing in. Once they rush in, they're going to hold or add to those positions.
More of an impulse move.
Yeah, and there are a lot of indicators that don't work before 1950. When I was in graduate school, the professor said the institutions will come to dominate this market from this point on because they'll get so big, and he was right. So any indicators based upon the institutions, like I like to monitor, I like to say, November through January, that's when they set up. So if the market is down, that means they're not buying right now. They're not too optimistic.
We just have some additional questions, Bill, if I can capture them. The one that I spotted at the top, do you have a cycle chart on the dollar? And either way, what's your view?
Yeah, well, I think the dollar is getting, let's say, January has been the strongest month of the dollar, so I'm pretty sure it's going up. And I'm still bullish on the dollar because I've lived overseas now for 35 years, and everyone overseas, especially in the Middle East, when times get tumultuous, they go to dollar-denominated assets. And as one of my old friends said, who was running the Abu Dhabi Investment Council, overall, the United States has the best legal system, has the most liquid markets. It is sort of the easiest place to invest. And I know that certain people in the Middle East got burnt by investing in Russia, which I would never do. They also got burnt investing in China, and so on and so forth. So, and also the dollar is the reserve currency. And when I see these ads about the dollar is going to become worthless, well, if it gets dropped as the reserve currency, it might go down very sharply in value, because if it's the reserve currency, if you want to transact with another country, you have to convert your currency into dollars first. And so there's an artificial demand for dollar created by the fact that it is the reserve currency. It does not behave like the rand or other currencies.
I think we're getting some comments there from Sahay about on that point. But I think there was a question on. Sahay was asking about the petrodollar, but Bill's asking, what do you think about the validity of the 80-day and 40-week averages in equities?
I haven't used them, so I can't comment.
And then we had a follow-up question on 4-year cycle and commodities. Is that on your radar?
Yeah, well, I think it was covered by Jake yesterday. Yeah, and his commodity work, it shows the basic broad cycles. Yeah. So I think he's right. I think commodity prices are headed higher, and I showed my views on gold and oil, which are really I really don't follow the soft commodities that closely. I did when I was a foods analyst on Wall Street, but not since then.
And now Sergey's also asked a question on the Bradley model, if you had seen its trajectory for the year ahead.
The Bradley model is about as Well, I'm trying to think. I already used eating soup with a fork. That's like running up the down escalator. Um, First of all, what price Bradley's book, the Bradley Barometer and how to use it. He doesn't state what data he used. I guess it was a Dow, over what time period he used it, how he had arrived at the valences, the pluses and minuses, how, how whether it made the market go up or down, or the weights. Now, if you handed that in, if you were getting a BS in any college, that would not be accepted. And yet, people for some reason think it's like a holy grail. And I tested it once over 5 years, 60 months, and it was right. I think it was right 48% of the time. So I corrected a lot of the obvious errors and I got it up to 60%, but 60% is the standard mark, and most 60% of all months are up. So the Bradley indicator to me is a very good basic idea. And it was from reading the Bradley book that Arch Crawford got the idea of actually calculating the average percentage changes in price rather than using some number that you cooked up. So the Bradley model was the inspiration. The only person to ever write a book about this was Man and Cosmos by Charles Clifford Matlock. Don't go out and buy the book. And he was a Harvard man who spent his spare time looking at the Jupiter-Saturn cycle and how it affected the economy and stock prices. But he wastes the first half of the book swearing before the Pope that this is not astrology. So he didn't get burnt at the stake. And the second half of the book is about the cycle. And today we can do that at the punch of a button. But that's what led Robert Hand and I to create the Astro Analyst, which led to market trader, a financial trader, market trader, and today Sergei Tarasov's timing solutions. That's the evolution. But the Bradley indicator, I don't pay too much attention to because it doesn't have any theoretical basis. He doesn't state how he came up with it.
And as a grand finale question, Bill, you're one of the few people in the team that have attended the Foundation for the Study of Cycle events. You met with the leadership, and you're aware of the heritage that we continue today. What can you say to people here and now that are looking for that conference in June? Are you looking forward to being there? And
oh,
what,
sure.
what
Yeah,
memories does it bring back for you?
I got my MBA in 72, and I met someone, it was probably Arch Crawford, the Society for Investigation of Recurring Events, SIRE, in New York, was an offshoot of the foundation. I went to a dinner, and I found out about the foundation. I immediately became a member and started to read everything from, if you remember the old days, cycles in oats, egg prices. I mean, really obscure stuff, but it was good to read it to see the approach that was used. And I never met Mr. Dewey, but I was very close to Richard Mogi, who ran the foundation in the 90s. And Richard very aggressively, I used to sit down there with him when he was in Pennsylvania and go through, and he used to pull out, for example, the Dow Jones from, is it 1780 or 1880, and explain to me how the prices were derived. And we used to go over the Wheeler War cycle and stuff like, in other words, the integrity of the data. He kept reviewing it. So I am very excited now because people, we have Cycles TV. We have different types of cycles programs. Everybody, it's amazing. Everybody can go to the same, like Donald Mack's Investment Book Center in Los Angeles. I know about half a dozen people who went there to learn from, what was his name? The strange cat. Name escapes me. But everybody came away with a different view of it. Some people were using planetary cycles. Bob Miner was using other cycles. And one very good book, Dynamic Trading by Bob Miner. That is a very good book. And the other book is Trading with DiNapoli Cycles by my old friend Joe DiNapoli. I always trust people who trade for a living because if they're not right, they don't pay the rent. So I'm very excited because we have now computerized it. We have databases. And as our listeners know, the book's by Peter Turchin, who lives here. He's Russian, but he lives here in Vienna. And they have a huge database, but they're taking social events, socioeconomic events, and they're projecting those out. So I think it's, but no matter what you do, no matter how much computer power, you're always going to have differing opinions. Some people are going to look at they announced at some meeting another guy I learned a lot from, Richard Diamond, who was a friend of Bob Proctor's at a trading course, which I took. He lived on Long Island. They said they're discontinuing this indicator, and he leaps up and he says, "No, no, don't." He says, "Don't discontinue that." They said, "Why, Richard? Is it that good?" He says, "No, it's 100% wrong. It's the greatest contrary indicator on earth." And so,
It's equally important, if not more so.
yeah,
Thank you very much, Bill. It's been great chatting,
you're most
and
welcome.
also, most importantly, sharing your insights about the FSC past, present, and of course, future ahead. Look forward to seeing you in person in June.
I look forward to seeing you also.
Thank you.
Good night.
Good night. So just got the message from the team to progress with the follow-up session. The one that I'll be hosting, themed Trump 2.0 Melt Up or Cycle Peak. Clearly, it's thematic and timely given that we're 1 week away from inauguration. So I'll cut to the chase and fast forward to the key insights. We kick off with Trump 2.0, a two-stage pattern based on buy the rumor that has passed into the election result and fade the fact 1 week from now, which is already in play, but the unwind may continue. Time will tell. The market seems to be mixed at the moment, so we'll be watching day by day, week by week. A few related points to that, and then the second section, S&P 500 bull trap reversal. What are the important points in terms of trend pattern, momentum, but also timing? I've included a brief mention on the decennial pattern just because it's been so topical, and it's been a hot debate amongst us FSC peers, but also many of you community members. And then right at the end, probably my grand finale close will be the cycle convergence, which is based on cycles that we all track in different ways with different variation views. But in recent research and also interviews with cycle practitioners, the consensus seems to be a super cycle alert for 2025 this year over the next few years. Certainly you would have heard a few people already mention that. Andy Pancholi talks about 2030 as a big cycle inflection point, and areas into that. And of course, you would have heard other versions too. I'll go into that point as well as others. Okay, so Trump 2.0 election playbook, according to my work, has been buy the rumor, fade the fact. It's based on the election fever climax amidst Trump's victory, which is now past headline news, but the market did get euphoric from it. Risk sentiment fueled by a mix of revived animal spirits, fiscal policy impact, and crypto-friendly deregulation. Crypto, Bitcoin did pop above 100K, although it's unwinding now. The big question, what next? So this pattern, think of it as a seasonality pattern. Bill was just talking about his interpretation of the presidential election pattern, which is always interesting. It's typically flat to weak, but if you look at the short-term zoomed in version, you get the extended upsurge from already a strong runaway market into November election result, particularly if it's in line with a predicted and preferred result, which was the case for both Trump and the Republican Party, which led to the red sweep. But what that typically follows with is a double whammy headwind. One, profit taking from very strong trends where people have made money and do want to lock it in. But two, policy stress test within the first 100 days. That's a political term, but it also tests out in the data, particularly when there is big change, which likely leads to uncertainty with polarized expectations, then that typically leads to volatility within the first 100 days of a new president-elect. So this brings up the theme of sudden change, and it's a behavioral insight shared by one of my original mentors, Mr. David Fuller, who worked with Alan Shaw. You heard Bill Sarubbi speak about Alan Shaw at Smith Barney. way back when in the 70s, an industry peer to others of the time. And the key insight there is sudden dramatic change is never anticipated by conventional wisdom. It's especially true with our impactful memories of a range of disruptive type shocks. I've highlighted a few notable ones: pandemic 2020, generationally high inflation 2022, heightened geopolitical risk throughout 2022 in terms of Russia, Ukraine, but then of course Middle East last year, and Asia here and there. Certainly we had Korea kick off in recent times, and talk about other event risks too. And of course, during this entire time, we've had legacy recessionary fears as well, proven wrong initially, and time will tell whether it does actually occur. Either way, the precarious zeitgeist of last year and years before proved in the end to be overcome as a wall of worry where the bull market just continued higher and higher. And we hit greed extremes and fear sentiment stayed at record lows. That's where we still are, but that does provide an inflection point to reflect on. So here's the evidence behind the data: record investment positioning, looking at momentum and liquidity. The quick measure I'll give you is NASDAQ doubling in value in the last 2 years. Also back-to-back 20% performance on the S&P 500. And the last statistic, which I find even more interesting, is if you felt tired being a bull, it's because we had 54 all-time highs on the S&P 500 last year alone. Now, that is a bullish outcome, and that is a strong trend. Follow the trend, don't fight it. But there is a dilution effect. There's an exhaustion impact, but there's also a dilution effect when we have these types of extreme statistics. And on the positioning side, both retail and institutional were proving at record levels. However, beneath the surface, multiple blended indicators that I use and others too have become rapidly less supportive. Asymmetric risk remains even greater. Again, we have to look at the price chart to confirm, especially in a strong bull market with strong liquidity. But keep in mind, we have seen a lot of momentum chasing, risk on rotation with hotter fund flows. And what that typically leads to is to fast moves in the opposite direction. And so here the question is, could we be in that paradoxical contrarian setup for a greater fool theory? Not something you can trade, but certainly something you and I can be prepared for and should be developing scenarios of just in case the risk side were to blow out. So one of the things I started doing years ago is to start throwing the ideas on a table in front of the trading screen and mapping out both positive and negative tail risks, the so-called white swans and black swans. So here's one I came up for 2025 based on my own views, but also lots of different investment banking research that I've been reading. And you can see the positive is Trump 2.0 reflation without the side effects. So that would be pro-economy, revival of animal spirits, and expansion effect, positive reflation or tariff impact without, again, the side effect that comes with that, and a consequential melt up. These are all the positives that we could experience in that upside surprise scenario. On the negative side, we have had plenty of geopolitical risk, but it hasn't yet been systematic or market impactful. We have the makings of a policy mistake from the Central Bank of the US. They cut one last time 25 basis points, and the rate market jumped 100 points up and is nearing the 5% historical pain threshold. So that in itself is a potential demotion or a lack of vote of confidence from the market and a potential bond vigilante event risk to come. You heard the view there from Bill of a potential inflation resurgence. I think a few of our FSC team members also share that perspective. I do too, and certainly the individuals I interviewed on FSC Cycle TV are concerned for that too. And ultimately, that could, each of those points lead to a risk unwind, and markets being so overbought in momentum and positioning terms could also just lead to that turn. What all of this means is that defense is the best strategy, but you don't have to go to one side of the portfolio extreme. You can apply a barbell strategy whereby that allows holding selective risk strategies. Key point there is selective, and really kind of focusing sniper type selection of those trades that may be profitable. You just heard there tech may be negative, but there are other tech stocks that may outperform, as just shared by our previous speaker. So that's an example of selectivity and stock picking, and ultimately active management. But ultimately, we do need to lock in profits where possible and build some downside hedging. This is the key takeaway from this particular insight. Now, I do want to highlight the concern. There is clear and present reasoning for it. And I want to focus your attention to the chart on the left. And this is something you can do on a yearly basis and just see what the probability distribution curve is for market return. I've done this for market return on various markets, but also on Wall Street's consensus views for market performance for the year ahead. And interestingly, they do match up. What it does show is that we are in abnormal positive performance territory. NASDAQ did double in value, and we did have back-to-back 20% returns on the S&P 500. But if you actually want to see that in terms of probabilistic measures, we are close to the peak of a distribution. You can see there 2024 is just there. 2020 is the peak. But I do want to point your attention to the left tails where we had 2022 shock to inflation rates and the geopolitical event risk. And then that was a 20% drop in the index, but 40% drop on tech. There could be an echo risk of that happening again. And then the tail risk, wider, fatter tail risk that many of you will have back of the mind, 2008, 2000. These are the big bear cliff drops of at least 40 to 50%. So that just gives you a statistical reference point. But what this does tell you is why the chart on the right matters now more than ever. This is why typically fear beats greed in volatile cycles. If you want to make money in markets and you want to have this type of market performance on your portfolio, the top blue line that is shooting up like a straight line, the primary objective needs to be risk management. Now, what does the data show? This is what happens when you miss the worst 10 days. You can backtest worst 5 days or use whatever metrics you want. You're going to get similar results. And if you exclude the best 10 days, i.e. the FOMO effect, you're still making money, but significantly less. So it's the relative underperformance of X best days versus X 10 worst days. Buy and hold is somewhere in the middle. That works when markets are behaving in a rational, strong trend, low volatility manner. But as we all know, that doesn't last forever. And that's why we need a mix of the two. Active management, where we can look for the best performers and the market timing opportunities, as well as risk management. Now, the big issue here is, from switching from FOMO to FOLO, is that our brains are wired in a specific way, according to the work of behavioral expert Daniel Kahneman. And ultimately, we tend to focus on one side of the risk-reward profile for survival reasons, but also for behavioral conditioning. Ultimately, while we don't control that or the changing seasons in the market, we can at least choose to adapt. And that is my call out to everyone. Whatever your view is in the market, do prepare for a change in trend as and when that does happen. Okay, so let's cut to the chase in terms of markets here and now. Have a look at the global model rotation, which is a systematic kind of trend, best and worst measure I look at over time, global cross asset. And we can see here a tale of two stories that remains. So Trump 2.0 risk trade shakeout from the upsurge that we saw late last year, Bitcoin overbought and unwinding sub 100. It still looks like it's in a sideways to topish pattern. S&P 500 potential bull trap reversal according to my work. However, we do need to confirm a make or break level, which I'll highlight, a pre-election price gap. And then the dollar, which only recently looks corrective after a strong upsurge. And in future sessions, I can feature more on that. Now, the second part of the story is inflation proxy, and this is probably what we're mostly being blindsided by because we're focusing on strong market returns in risk and in equities as a case in point, as well as the Trump 2.0 effect. But that's not a one-sided story. The other side is inflation resurgence. US 10-year yields did jump 100 basis points just after the FOMC rate cut, which is paradoxical and typical of a loss of confidence in the market, as well as structural inflationary forces. That was also apparent on break-even spreads in terms of inflation expectations, and that translated into the commodity market in terms of oil, which has a short-term pop to the upside, as well as copper on a relative basis. And then, of course, gold has been the outperformer of most asset classes last year, 40% from low to high, outperforming by equities by 10%. And so it's having a healthy unwind within a volatile range and likely to break to new highs. What you're looking here on the table, just to be provide the educational framing, it's long-term, medium-term, short-term trends from left to right, so trend performance over time, and then you have a quintile system, strong versus weak, best and worst. And you can see that Bitcoin at the top, rates going up in pink, and US equity market in blue, fall from grace. In absolute terms, it was holding up, but relative terms, it's becoming weaker. Okay, S&P 500 bull trap question mark, because this has been a work in progress. The key markers that I'm continuing to watch are trend pattern reversal, momentum exhaustion, bearish momentum, bearish timing confluence. I did have a focus also on rotation in terms of sector leadership. I kept it out for now just because that's been mostly mixed, and it's the same story that we know, tech concentration with late cycle leadership, which may or may not prove out. For now, I'm just focusing on these 3 points, which should give us enough ideas for what may follow. Trend pattern reversal. This is the updated chart showing an impulsive trend reversal still in play with a corrective volatile regime. For those of you Elliott wave pattern watchers, this could be a wave 3 top. We can argue to what magnitude, but still it's a trend reversal inflection point, which did break through the pattern support and key levels. But of course, we are now in a potential recovery upswing, which hasn't achieved a new high breakout above 6,000, which would be key. And it did find support at the election price gap between 58.60 and 5,700. That remains a make or break zone. And it's very much related to the confidence in the market for Trump 2.0. If we hold, then Trump 2.0 actually has a near-term positive impact. If not, then it's just showing that the market is unwinding from overbought conditions and potentially waiting for that 100-day stress test of Trump 2.0 policy impact. The other point here is that there are short-term timing factors. As you can see, the symbols on top of the chart, and I've only highlighted the ones in recent times which have correctly timed the inflection points to the downside, so the tops in this corrective wave. The next one is coming up into inauguration week, so there's additional timing pressure for that. And then for those of you that look at trend measures like moving averages, the 20 and the 50 short-term, medium-term are exhibiting a bearish cross, but the short-term price action remains mixed. So we do need price to confirm to the downside new low breakdown beneath the previous swing low, but also beneath the selection price gap 5860, 5700 to confirm the bear trend reversal, but also that trend signal, that bearish cross. Okay, and then of course, look at the indicator, you see the bearish divergence which led us down, but now we have an early stage bullish divergence in the opposite direction. So that line in the sand is going to be the decider as to whether we recover strongly or fail and reverse down. I'm just going to quickly check the chat, see if there's any questions on this chart as I fast track through. If you have any questions on this chart, let me know. I do share these key market insights with the Foundation Market Working Group, which is a bi-monthly premium gathering of like-minded cycles practitioners. So, you know, there are many questions that get asked there and also ideas that get shared. So if you have any questions, you know, whether you're a part of that group or part of the community attending, just let me know on the chat. Now, the other part of this is the momentum exhaustion. This was clear early on, but we had a high probability reversal signal on one particular indicator subset I look at, which is developed by Tom DeMark, and that was across multiple timeframes, monthly, weekly, and daily, and it finally proved out in recent times. So this signal is done, it's already confirmed, but I highlight it as an after the fact print, but also as a question as to should there be more of a shakeout or not. Is this the extent of the move and we just continue higher, or is there further downside ahead? Now I'm just highlighting there the election gap as a further confirmation of the exhaustion signal, and to highlight that if this signal were to weigh further lower, it is part of a bigger bull trap signal. What do I mean by that? S&P 500 bull trap scenario 2007 and 8 is the analog I've been following for most of last year, 2024. I did originally look at other analogs, including 2000 Y2K bubble burst and crash, as well as the 1970s and other analogs too. This seems the best fit in terms of a historical rhyme, not a repetition, but a rhyme, which is often how these patterns play out, because we had an all-time high, which was a head fake signal. In 2000, we had more of a melt-up stage, kind of a inverse of V-top, whereas 2008, it was a marginal high and then a three-stage corrective pattern. That typically plays out as a fall, rally, and rest of fall. And now the mid part of that, the rally phase is the head fake, which leads to the rest of the fall. And interestingly, that followed two event risks of that time, which echoed just recently the Fed pivot of 2007, as well as the election for that period too. So there's an eerie price analog, macro analog, and even time analog. Look at the corrective period. It was from 1 year to the next, 2007 to 2008. It was only in the first half of 2008 that we started to make a new low breakdown beneath a structural key level. The equivalent of that would be 5,700 and 5,600, the election pattern levels I mentioned, as well as the lower 50% retracement levels that I've also included. And ultimately, if that were to break as it did then we would get a similar result, a rest of the fall ahead. Now, what makes this really important is the bull trap scenario risk from a behavioral perspective is based on excessive sentiment, leverage positioning, forced, not chosen, but forced to reverse amidst elevated volatility. So this is what makes this such a fast, dramatic downside surprise, which are harder to react to, and of course adapt in terms of the market and mind strategy. So again, to be if this were to happen or not, it's good to develop scenarios just in case and to be prepared. Bearish time and confluence, we're just going to fast track to the cycles, and I've added a little bit on bigger cycles, including the master cycle that the FSC uses as originally developed or popularized, I should say, by our founder, Edward Dewey, the 41-month cycle. And I've included something on the decennial too. But before we get there, election pattern and FSC model first on the short-term basis. So this is just a recap of the election pattern playbook based upon my analysis. Short-term by the rumor fade the fact, that's the short-term pattern, but the longer-term pattern I've included here based on data from Fidelity. You can see the subsequent year one of a new presidential election leader is flat to down, whereas the short-term pattern is also the same thing, but just on a more zoomed-in time frame. Now, the double whammy of factors are typically profit taking, especially when we're at extremes in terms of momentum and positioning, as well as the first 100-day policy stress test, particularly when it's amidst polarizing expectations. Yes, the market is bullish, and yes, we're even pricing in a peace dividend in terms of potential stability in Europe and the Middle East, but there are potential event risks still ahead. Time will tell. Certainly inflation is one, markets in general, as well as potential additional event risks that we have yet to discover. FSC timing model has been bearish in the short term, but there were different variations of that bearish pattern, one suggesting a year-end rally, the other suggesting an imminent correction. Either way, fast forward now, we are entering the risk zone of the FSC short-term timing model based on certain harmonics on this chart. That is the one to watch for now, because that will change from day to day, week to week, depending on market behavior. But the one that remains fixed in terms of the pattern and the timing is the long-term weekly, suggesting a major top here and now, and likely downside risk into the first half of this year. Now we have to carry on watching the short-term cycles to see how that plays out. But nevertheless, there is a major top in place according to the cycle model. Now, what's interesting is if we look at diversified external data, the chart on the far right here, based on sentiment data using solar cycles, based on sun impacting mood, when this data is high and peaks, typically there's euphoria, and when it's down and hitting an extreme low, there's pessimism in the market. And when did sunspot data peak? Summer last year, 2024. The trough, I might add, is into 2030, 2031. And I will allude to solar activity at the very back end of this presentation when we look at space weather cycles, which is something I look at where possible, as do some of our team peers as well. But we have a non-correlated external data set using sentiment based on macro influences of the sun that we see from day to day, also peaking out summer last year and suggesting a top is in place too. You would have seen some cycle TV footage from both myself and team colleague Lars von Dienen on this sentiment data. I believe also Lars has actually uploaded it onto the FSC model, so you can even map out cycle data on external macro data too. And thank you there from Paul. Inversal solar activity plays well for natural gas. And also, if you go back 100 years, solar data was used very much as part of a influential driver on manufacturing and economic activity. Look at the work of Dewey. He did actually write about it, as well as British economist William Jevons and Russian scientist Chizevsky. We've also covered some of those individuals in past videos too. On this slide, the 41-month cycle signals a peak into 2025, although there are variation views as to whether that is leading or lagging right now, and whether that will also be influenced by other cycles. But either way, do keep that in mind. This is a screenshot of the opening chapter of our newly republished Cycles book by Edward Dewey. And you can see here the past cycles developed by Dewey from 1868 to 1957, then updated by the team. And you can see here the most updated version is the chart below, which marked the peak in 2007 and the GFC that followed, and then more specifically, a potential peak right now in 2025 with downside in the following year or so. So that's something to keep in the back of the mind. Do try and plot it on the FSC model to get a more real-time tracking of it. Now, what about the decennial pattern? This has clearly been a top story, and certainly hotly debated for good reason, just because it's important to know what that means for markets. Does this mean year 5 is typically a positive sweet spot or not? Typically it is, but not always. And that's the main point I'm going to highlight here. And if you want more insights on that, both Jake Bernstein and myself have done a full video on the decennial pattern with different perspectives, but still worth watching. The main thing I would recommend with the decennial pattern is to go to the source and research one of the original writers of this pattern, which is published in a book called Tides in the Affairs of Men by Edgar Lawrence Smith. You'll hear many of us citing the primary source authors of these cycles, if they're known, just so we can, make sure that we're connected to that original thinking and research. What's often missed and I think forgotten, partly because so much time has passed, this book was published a long time ago, 1939, is the cause, effect, and timing method research of this pattern. So Smith's theory resulted from combining two other theories, Wesley Mitchell's 40-month cycle theory and the theory of seasonality. It was not just one pattern standalone. Do also note that it's a 40-month cycle variation too. Now, more importantly than that, there was a variation that was spotted in the timing. Combining these two periods, Smith theorized that there would be a 10-year or 120-month cycle. This would result from 10 12-month annual cycles and 3 40-month cycles coinciding every 10 years. So it was a series of cycles that he was watching that chimes in on a decade basis, and therefore the decennial pattern. But there were variations. It wasn't a fixed pattern according to his work. And his own research, he then hypothesized that occasionally a 9-year or 11-year cycle overlaid the decennial cycle. This is such an important point that I highlighted it in yellow so you can see it bright on your screens, but also I did the same on my side in research notes, because I then realized, static cycles work when they do, but they're very good for, statistical backtesting, and of course, looking for consensus versus outlier, and having that body of evidence as a research note. But there are times where we need to take care, particularly if the original research is open-minded on other influences and effects. Now, the decennial cycle, if you test it across 100 years, does prove out an asymmetric shape with underperformance at the start and end of the decade, and ultimately a sweet spot in the mid part, year 5. Variations do occur, especially if external sentiment data is used, and mainstream industry studies such as, it sees this mostly as a fixed pattern, but often marked by occasional outliers. I'm going to show you what that looks like. This is a chart I did years ago and for internal research for a macro fund that I was working for with mentor Robin Griffiths. And back then, 2015, 10 years to the year, the cycle was flat to underperform. Now, it does happen. It's not the end of the world if there's an outlier, but it did intensify my own research into the plausible influence of nonlinear timing and natural cycles, but also the decennial itself. You can see here the outliers. Best performing was 1915. Worst performing was 2015. My fortune of the time. And the consensus is, you can see there the blue line, 10-year average, the consensus is positive. But keep in mind some of the reasoning behind this. I believe Mr. McLennan, who's part of the FSC Master Working Group, shared an insight that manufacturing data is partly a macro influencer to the decennial patterns. So in strong economic activity seasons, the decennial pattern year 5 tends to be positive. You also heard my colleague Andy Bencholi talk about context. In a very strong market that is overstretched like an elastic band, the gravity takes effect, and the inclination is for a snapback regardless of a potential cycle influence for that year. And then also keep in mind the other point that was made, cycles within cycles. It depends on your cycle framework. If you're looking at multiple cycles and one is positive, the other one's negative, or there's a lead or a lag, then you have to also factor that in. And again, remember to watch back the video on decennial patterns by my colleague Jake Bernstein and myself. Just getting a message from Mr. Patel. Do we have a month for the peak of the nominal 41-month cycle? Yes. So according to some analysis of our team, it's literally been the last few months, I think into Q4, but we're still tracking that to see how that plays out. Of course, you can get cycle skew, and we still need price to confirm to the downside. Hopefully that answers your question. You can map it out on the cycle model. And that's probably the best guidance I can share. Okay, cycle convergence to close in the allocated time. This is probably the most important big picture macro perspective that I want to share. And I'm really charged up and partly inspired and excited, but also a little bit scared. The one time I hope some of these views get proven out wrong. And you'll be able to learn a little bit more about industry peer views in Cycle TV with interviews with David Murren and Simon Hunt. They're building up some strong record views for good reason, thematic and timing insights, but also all alluding to cycle convergence. So it's something which I hope proves interesting to everyone. And I welcome any questions or insights on this point. So just as a recap, the methodology that I followed for 20 plus years based upon teachings from my mentor, Robin Griffiths, is an adapted cycle schema from the work of Joseph Schumpeter. And Joseph Schumpeter basically studied the work of prior cycle pioneers, including Kondratiev, Jugular, and Kitchen. We added the seasonal cycle as a short-term variance, which applies cross-asset, but notably US equity markets. What matters most, and a top-of-mind question, is how prepared we are when there's a cycle convergence with some of these patterns, as they likely are now. I'm going to shift away from the methodology that I've used for years, based upon the method of other cycle practitioners and focus on one of the cycles that are underpinned by it, the debt cycle, which is an important part of Ray Dalio's model of Bridgewater House, which features big cycle of money, credit, debt, and economic activity. And for those of you that want to look up more detail on it, just look up his book, Changing World Order, or the debt cycle research. It operates in 6 stages, and in the latter stages of debt burden, hits a reckoning inflection point that either through restructuring, debt restructuring, or accelerated inflation marks a disruptive moment. This normally follows a period of internal, external turmoil, such as wars, revolutions. On a big picture scale, it marks the peak and decline of an empire. So, and there have been prior empires to the one depicted here. This is based on US, but of course, we've had a British Empire before, and other empires too. Look at the interview with Mr. David Murran. He covers this in great depth. But what's interesting here is you can see here where it's highlighted, we are here, debt bust and economic downturn, print money and credit, and then you can see the disruptive nature of all of this once we actually get to that moment of reckoning. Now, this creates a poison chalice effect that will likely make the hopes that President Trump will reinvigorate the US and global economies difficult to achieve. According to the work of Simon Hunt in the interview available on Cycle TV, he believes that at best, there could be a 2-year period of faster growth, but accompanied by rising inflation, which chimes in with this empire model. Keep in mind, it's also a depiction of a transition from unipolar to multipolar as well. And there's lots of useful data as to how this pattern has played out in history too. What this also means is a likely rotation in commodities as part of a commodity super cycle, outperforming equities, as this ongoing restrictive monetary condition continues and financial assets and consequential secular inflation forces maintain. This is a chart ratio looking at how things can swing, and ultimately we're starting to see this in some commodity sectors, but still many more to follow in the near term. Now, one cycle to watch as part of the commodity trend is the contractive wave. And you heard my team colleague, Bill Sarubbi, but also I believe Andy spoke about it too, and maybe others. Also, interviewees on Cycle TV feature it too. The contractive wave is typically 50 or so years, but on a higher harmonic, 100 plus. And when you map it out on CPI data, typically highlights inflation spikes, but also social and geopolitical disruption. The latest window is from this year for future years ahead. And it's also highlighted by the work of others, such as Ray Dalio, Strauss-Howe, in terms of fourth turning, and the interviews that I highlighted from David Murran and Simon Hunt. So do watch that. It's not Armageddon, worst case scenario here and now, but clearly it's telling us what we already know in terms of when you look out your window and you watch the headline news, and just be aware of some of those risks now in the present. And the closing chart I want to highlight is weather cycle alert, something we can talk about maybe at the cycle conference ahead. It's called the Gleisberg Centennial Cycle. And when we talk about potential weather changes, but also drought effect and 1930s Dust Bowl, this is the one to look at. I'm going to close here just so we can play time catch up and close with our fireside chat, which is yet to come. So just as a recap, latest insights, S&P 500 bull trap reversal, and cycle convergence. Watch back the video for more insights, and please feel free to ping me with questions on email or on social. Okay, on that moment, Richard, if we can connect, and I'll stop sharing the slides.
Yes, thank you, Ron. That was excellent. And thank you for your excellent hosting. Really appreciate it. So it's been quite a few days with all the presentations and a lot of overlap and a lot of differences. We've also seen, you did those interviews with David Murren and Simon Hunt. So I'm curious, just first, blush, what's your overall read in talking to everybody that you've talked to over the past month or so?
It's kept me up late at night. I won't lie. And when I asked that question to our interviewees, they said the same thing. They said first thing in the morning, late at night. They're focused on this. They're deep in research. They're concerned. They still live their lives and do their work and trade in invested markets, but they do use cycles as a practical way of navigating future trends. And I think it's within that philosophy that we can benefit so much.
I'd say that if I had to sum it up in a sentence or two, that we're closer to the top than to the bottom.
Exactly that.
Right.
And there's asymmetric risk between the two.
There is an asymmetric risk. Um, and yeah, but overall, it's clear, we're at the 41-month cycle tops. We're at a number of cycle tops. We have this new president that seems in the US that seems to be different than what we've seen over the past 20, 30 years. And it does seem like volatility is likely to be in play. That seems to be one thing that almost everybody agrees on.
There's a great insight that was shared by one of our keynote speakers, Robert Prechter, last year. And in the Q&A that we had at the end of his presentation, he said, this will likely be the time for cycles.
Right. Yep. Indeed. Let me show you something that I was just playing around with that I think is pretty kind of cool.
Please, I think share screen should be active.
So I grabbed, let me just start here. I took the chat comments from the past 3 days and I put them all into this AI tool. Okay, this is called Cursor. And Cursor is it's really like a developer coding environment, but it uses ChatGPT and Claude, etc. And so you can put text files in here, and then you can, use Claude, Anthropic, or ChatGPT to ask questions about what's in the text. So I said, based on analyzing the chat logs, here are the most, or well, I asked, what are the most common concerns and questions from participants who have been watching these presentations? The number one was Bitcoin. So Bitcoin and crypto markets, multiple questions about Bitcoin cycles and price predictions. It's fascinating how everyone is interested in Bitcoin.
Strong market. And we had a diverse view on that, Richard, I might add.
Right.
Some bullish, some bearish.
I personally find Lars's analysis very compelling, particularly because he's really gone to the mat with it for like 4 years now, and he's been right. So that's been impressive,
Yes.
And obviously we have a very pro crypto president at the moment and lots of technologists in this administration. Meanwhile, Bitcoin doesn't have any earnings. Hard to put a valuation on it, right? And the cycles, if I look at the cycles, just using the cycle analyzer, the dynamic cycles, it looks like a time to be cautious. But Lars's analysis has been very persuasive for me personally, and I'd say that I'm a cautious bull on Bitcoin at this point. And I do think that Bitcoin is likely to play a role in an increasingly digital economy. I do think that AI, look, I mean, I'm using AI here, this tool, these tools are unprecedented. They are something new. And I'm using them more and more. So I'm sure that they're going to be used throughout our economy. They're going to change things. Like there's no doubt about that for me at this point. And I think that as it'd be interesting to look at some of these technology cycles, actually, the innovation cycles, because I do think this is a new innovation. And, I can see, or one of our fellow board members, Brad Rotter, once said to me, computers need money too. And there's something to that, this idea that computers will be exchanging data, especially as we're building out this AI world, and that there has to be an exchange of value, for that data and for the insights from that data. And so it's interesting how blockchain and crypto might play into that. Any other thoughts on Bitcoin yourself?
Well, following the pattern that's happening right now, it's looks, I mean, clearly a loss of momentum, but it is choppy right now around that 100K mark. The cycle model, last time I checked, is suggesting a top here and now. But then there's a question on timing, confirmation, price magnitude.
Yeah. Look, my biggest takeaway in general, right, when you get these conflicting views, is that we all ultimately have to formulate our own views.
Absolutely.
And Lars talked about that on day one. I talked about that on day one. We are an educational institution. We do not know what's going to happen with Bitcoin tomorrow. The cycles don't tell us any guarantees. As Bill Sarubbi says on the cover of his presentation, the only certainty is a probability, right? There are no certainties. Only
I was just about to say that probabilities, not certainties. I love
probabilities, not certainties. And yeah, you have to figure out what your own view is. And you have to figure out how much you're willing to risk on that view and how all, your risks fit together. On the whole, though, I have to say Lars is the most impressive Bitcoin analyst we have. And I liked his point about kind of seasonality, the halving cycle, and the 200-day nominal cycle. And I found his analysis actually fascinating, where he took the two kind of cycles on either side of the nominal cycle and he looked at their interference patterns. And he came up with a 5-3 wave pattern out of the interference patterns of two cycles on either side of the nominal cycle. Bill Sarubbi said something interesting too in his talk at the end about Richard Mogi, saying that, if you have like an 80-day and an 84-day cycle, use them both. So that was interesting. That was like a little new idea for me that came out of these sessions. And we are going to be talking in depth about this stuff in New York City. By the way, I bought my own ticket to the conference today. So I'm paying to go to this conference because I want this to be a peer-to-peer conference. I want us all to be on an equal footing. I don't want it to be a show where some people are up on the stage and others are down in the audience. No, we got like a, kind of like a amphitheater on both sides seating. There isn't really a stage. So this is really cycle practitioners and students and enthusiasts getting together to talk about cycles in person. And so really excited about that and hope everybody can join us there. Number two question from the chat is market direction for 2025, and I assume largely stock market. Obviously, we've seen a lot of reasons to be concerned, right? I'd say there's a consensus around volatility, increased volatility. But I didn't hear anybody really come out and make an outright bearish call. And I think everybody kind of hedged the cycle concerns with, hey, the trends are still in place. Did you hear anything different yourself?
Yeah, absolutely. Actually, Jake typically hits that point head on with setup, 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 follow through, follow through, follow through. And I think that echoes in my mind all the time, because ultimately the market has to confirm in whichever direction it moves. And in this case, the trend is still up. It's in transition short term, but it still is up long term. And so we certainly have to follow. And one of the points that you make, Richard, time and time again, is risk management is key, whatever the view.
Absolutely. I was remembering, one of the early things Jake Bernstein said to me. I don't know if you've heard me tell this story, but I was just getting interested in investing. And I met Jake at a conference and I said, what's the difference between the winners and the losers? And he said, the winners don't need the money. And I always thought that was a fascinating comment. The winners don't need the money. My first reaction was, oh, okay, the rich keep getting richer and the rest of us keep getting the shaft. But over time, I've come to see it's really about like positioning ourselves in the markets in a way that we're not going to get, thrown back on our heels, basically. So markets are going to do their darndest to throw us all back on our heels, right? I mean, just today, I don't know if you saw the close in markets, but we're pushing to new highs for the day in equities, and then the whole thing reverses, over a 5-minute, 10-minute period at the end of the trading day, and I see that happening a lot in markets right now. Markets are really trying to throw us off balance.
It's choppy.
It's very choppy. There's got to be flow for the institutions that run the markets. And I think that's really important that we make sure we're positioned in a way where we can always be proactive and respond to a crisis, right? Instead of kind of reacting to a crisis. So I think that's very important to keep in mind. The real estate cycle came up a lot, right? That was the number 3 concern from our viewers. A lot of talk about the 18-year, 18.6-year cycle and how that kind of relates to the Kondratiev 54-year cycle.
Yeah, Andy presented at the end of his presentation, and I believe Akhil Patel will be at live in 2025, so he'll be at the conference as a speaker.
Yes, indeed. So excited about that. And good confirmation that Andy shared, that Akhil recently shared, that indeed they're still forecasting the top of that real estate cycle in 2026. It is interesting that we do have a real estate developer for president now here in the United States. So I don't know what that means, but it does seem interesting timing given the 2026 cycle. He wants to remake Washington, D.C., I've heard, right? So maybe he's going to build the tallest building in the world in Washington, D.C. Who knows? It'll be the Trump Tower. But what was new to me that I hadn't really thought about before, and it's so obvious, I don't know why I didn't think about it, but the 3 times 18.6 being 54. I mean, 3 times 18 is 54, and how that relates to the Kondratiev cycle, that 3 of these 18-year cycles, equal the 54-year cycle. So that was very interesting. Any thoughts on that yourself?
Well, I was going to say, if our team colleague Ray Tomes was here live, I'm sure he would also talk about the scientific evidence of these cycles. Certainly, it's. I recall there was a chart he shared with me on wheat going back hundreds of years, and there was a pattern there, as well as other natural patterns of the K wave. I think it also appears on spectral analysis as well.
I like Serge's comment that he's going to build the tallest building.
That's an indicator in itself, but I wouldn't want to measure that myself.
All right, folks, if you've got questions that you want to Ron and I to share our thoughts on based on the 3 days of presentations, I'll keep working through this a little bit more here, and also just to show you these tools, which I think are amazing. Access to materials, recordings. Yes, anyone who registered is going to get access to these recordings. We'll send them out after the event concludes, and I think they're also going to be available on YouTube. Lots of geopolitical concerns. That was interesting, right? I saw some questions about Taiwan. Bill mentioned the Crimea and, related to the 54-year cycle. There's a lot of questions about Taiwan right now. And we didn't really get Bill to weigh in on that, but it would be an interesting one to explore some more, maybe on a Cycles TV episode.
He also made the point about technology and how that's changing warfare, and may or may not be a welcome development. Certainly, I think the point was that some of the technology means that we'd rather not go there because it's just so such an extreme make or break moment. It'll be interesting. Right now, the market seems to be pricing in a peace dividend with Trump 2.0 and his negotiations in Europe and the Middle East. So that sounds positive for now. And this is where this question of determinism and what the cycles suggest versus free will or even leadership and how that may change the course. So I think you asked that question to our guest from Fourth Turning, Neil Howe.
Mm-hmm.
Did you not ask the question, is this inevitable? What was his response on that?
Yeah, the most interesting thing to me about Neil Howe's book is that he said that the United States is the country that most rejects the idea of cycles culturally, and yet it's the country that seems to be subject to cycles the most of any country, right? The cycles are most pronounced in the United States, where supposedly, we just reject cycles as being some kind of astrology. So I thought that was interesting. And, I think that Neil and I share the view that, an awareness of cycles can change the cycles. And that ultimately, one of the biggest benefits of studying cycles is an awareness of the cycles so that we can respond to current events, in light of what the cycles of history are suggesting we're likely to face. You see that a lot with Dalio right now, also talking about the debt cycles, and it's good stuff, it's very cogent and coherent. And yes, there clearly have been these debt cycles. And yes, we're clearly at the late stages of a debt cycle. So it would be ridiculous not to say, hey, let's study cycles, and see how we might respond to this situation that we've seen before. I do think we have a choice of how to respond. I don't think it's inevitable. But if we put our head in the sand and pretend that cycles don't even exist, then we don't really give ourselves a chance to respond. We're really actually negating our own choice. So, Bill Arndt, the U.S. will be Trump's 7th bankruptcy. I am kind of happy that we have somebody who knows how to handle bankruptcy at the helm. I mean, he's managed to turn bankruptcy into another level of success. Maybe he can do it for the United States too.
But perhaps it's a post-shakeup recovery story. I mean, maybe we get a shakeout early and then ultimately the rebuild is Trump's ball game. Time will tell. These things
We
play
shall
out in
see.
interesting ways.
Um, one other thing well, a couple other things, but one thing I wanted to show. On Monday, Lars has a very special interview with Michael Howell of Capital Wars, I think his Substack is called. He's doing some really interesting work on liquidity, measuring, global liquidity all around the globe, and then looking at those liquidity flows. And Lars interviewed him, and that's going to be on Cycles TV on Monday at noon. So I'm really excited about this interview. I think it's going to be a very interesting interview. And the idea of global liquidity flows is obviously of interest. And then Michael Howell actually contacted Lars because he was interested in studying cycles and global liquidity flows. So everybody should tune in for that.
Exciting stuff.
Yes. Just one more thing here on Cursor. I actually went and grabbed the transcripts, just rough transcripts from the speakers. We're recording these sessions. We can get transcripts. And I just said, what are the presenters share and what are some of their differences? So multiple cycles interact and overlap. All presenters acknowledge that different cycles operate simultaneously and need to be considered together. I think that's true. 2025 appears to be an important year for market cycles, though they arrive at this through different methods. I think that's true too. That's an interesting point. We're all saying 2025 is important. The 41-month cycle is topping. It's the 5-year cycle, fifth year of the decennial pattern. It's the nearing
Solar
the top
activity
of the
peaked out.
18.6-year cycle. Bill's connection about, the 1970s, we're kind of nearing the 54-year mark there. In fact, 2024 is the 54-year mark. So from 71, was that the year Nixon took the US off the gold standard? And now we're at the 54-year mark from that, which is 3 of these 18.6-year cycles. It does all seem to converge in a way that certainly raises the eyebrows.
And we have external data based upon solar activity peaking out last summer. As
That's a great point, Ron. We actually didn't talk about the sunspot cycles. Nobody covered the sunspot cycles. Can you just bring us up to speed on that?
Well, very briefly, a peak in sunspot cycles impacts mood in terms of euphoria at the top and pessimism at the bottom. The bottoms are more reliable than the tops, according to, most research I've read and personally done. And they coincide with market shocks and recessions when they do happen. But in this case, the top happened in last summer. It was lower than previous peaks, but still a peak. And for those who want to look at space weather cycles, look at the Gleisberg pattern. That's kind of drought risk, and also relates to solar activity. Outside of my remit, but I'm researching it now. Came up in the interview that I did with Simon Hunt, and it's also why, for example, I think Andy talks about the Dust Bowl risk of 1930s happening in future years, not here and now. I think it's partly to do with that space weather cycle.
One of the things that was interesting to me this year in going through the archives was I found some records from who was the radio analyst at RCA, famous guy. You and I have talked about him.
Nelson just
Nelson.
came to mind.
Right, Nelson. So Nelson was a radio wave scientist at RCA. He got to go up to the top of the RCA building and look for what was causing disturbances up in the ionosphere for shortwave radio transmissions, which were, a military grade issue back then. Um, and his work basically said that the planets influenced the position of the planets correlated highly to geomagnetic storms in the ionosphere, which disrupted the shortwave radio signals, and which the military needed to know about when those would happen so that they could be prepared for them. And there were all kinds of letters from the military upon Mr. Nelson's retirement, saying how important his work was to the military. So that was fascinating to see that, and I do think it kind of, this area of geomagnetic data, of sunspots and solar storms, and the interaction of the planets around some of those physically measurable things, um, is an area that I hope we'll explore some when we're together in New York. And I think just in general in 2025 also.
Should hopefully be joined with Ray Holmes. So we'll have a science day, I think, just ahead of the conference back to back. So there'll be interesting cycles in nature and science shared there, which will be great. And plenty of overlap, of course, on the market side.
Yeah, great. Appreciate the links here, everybody. Keep them coming. If you have things that you'd like us to look at that you want to share with the FSC, it's fantastic. We love to get your input. Support team, can you? Oh, I see you already threw it up here. So let me just share one more time. I mentioned the Michael Howell event. Let's see if this opens up here. Yeah. So here is our conference registration, cycles.org FSC-live-in-25. So here's where you can register. There's only 100 people can attend this event. We're not going to be doing a lot of recording. This is really people getting together in person. That's what this is going to be about. So if you're serious about cycles and you want to make new friends and get together with people who are also serious about cycles, this is where we're going to be. This is when it's going to happen. And please join us to do something that I think is going to be really unique. So make sure you don't forget that. This is our 5th year of doing this Market Summit, so that's a nice milestone, our 5th anniversary, and been a good year. I think we've grown our YouTube activity incredibly, grown our membership at a time when a lot of other groups are struggling, actually. So that's been great to see. Anything else you'd like to add, Ron, to wrap this up?
Looking forward to meeting people in person in New York, June. I think it'll be an exciting opportunity for all of us to just chat, share ideas. And I love the idea of cycle practitioners sharing their passion for the study of cycles. That's what we're all here for.
Mm-hmm. Just looking at some of the comments here too. We appreciate your appreciation. It's great to see. So I think we've covered it all. And Monday, Tuesday, we'll be back on Cycles TV. So please join us on YouTube. If you're not a member, please join the foundation, support us. You get access to incredible tools, and you get to engage with us. So really appreciate your membership, and thank you everyone who has supported us this year. Thank you, Ron, for all the support you've provided and connecting us with other groups. Really appreciate it. Thank you very much, everybody. I hope everybody has a great 2025. Just be careful out there. Make sure you don't get caught flat-footed. Expect some volatility, and watch the cycles, but not just the cycles. All right. Thanks so much, everybody. Have a great year. We'll see you on YouTube and elsewhere. Bye-bye.
Thanks all.